October 19th, 1987, the stock market crashed over 30% in a single day. And while most people were completely blindsided, one trader had already seen it coming. Not because he had insider information, not because he got lucky. He saw it because he understood something most traders ignore: how markets actually move. And once you see it, you start to realize these big crashes and massive runs aren't random at all. Hi, I'm Rick Graham. Today I'm going to walk you through the exact strategy Stan Weinstein used to predict that crash, and more importantly, how you can use the same approach today to spot strong stocks early and avoid the ones about to fall apart. But there's one thing you need to keep in mind as we go through this. This isn't one of those complicated strategies with 10 indicators and constant screen watching. In fact, Weinstein believed most traders lose because they overcomplicate everything. So as we break this down, you're probably going to notice how simple this really is, and at the same time, how easy it is to ignore if you don't know what to look for. Stan Weinstein never tried to position himself as some market guru. He didn't claim to predict the future. He saw the market as a probability game. Not about being right all the time, but about putting yourself in situations where the odds are clearly in your favor. And the way he did that was by focusing on one core idea. Every stock moves in stages. Not randomly, not based on feelings, but in a cycle that repeats over and over again. Once you understand these stages, you stop guessing when to buy or sell. You start recognizing where you are in the cycle. And that changes everything. So let's break that down. According to Weinstein, every stock is always in one of four stages. The first is what he calls the basing phase. This is where price moves sideways for a long period of time. Nothing exciting is happening. It's slow. It's quiet. It almost looks like the stock is doing nothing. And because of that, most people completely ignore it. But what's actually happening here is accumulation. Smart money is slowly building positions without drawing attention. Then comes stage 2, the advancing phase. This is where the stock finally breaks out of that range and starts moving up. Momentum builds. More people start noticing. And this is where the biggest gains usually happen. After that, you get stage 3, the topping phase. The stock is still high. It still looks strong. But something starts to shift. Momentum slows down. Price starts moving sideways again. And finally, stage 4, the decline. This is where the stock breaks down and starts trending lower. Now here's the part that trips most people up. Most investors end up buying during stage 3, when the stock already looks strong and feels safe. And then they hold all the way through stage 4, hoping it will come back. In other words, they're entering too late and exiting too late. Weinstein's entire strategy is built around flipping that behavior. He focuses on buying right as a stock transitions from stage 1 into stage 2, and getting out before stage 4 begins. That's where the edge comes from. But this leads to the obvious question. How do you actually identify when that transition is happening? Because it's easy to explain the stages after the fact. It's much harder to spot them in real time. This is where Weinstein's method gets very practical. He didn't rely on guesswork. He looked for a few very specific signals. The first one is price breaking above resistance. Not just touching it, not hovering near it, but clearly breaking above a level it struggled with before. That's your first sign that something is changing. The second is volume. When a stock breaks out, you want to see a noticeable increase in volume, because that tells you this move has participation behind it. It's not just random movement. It's driven by real buying pressure. And the third is the 30-week moving average. Weinstein used this as a simple way to confirm the trend. If the price is above it and the line is starting to turn upward, that's a strong sign the stock is entering a healthy uptrend. When these three things line up together, you're no longer guessing. You're looking at a structured setup. And this is where things start to click. Because now you're not chasing stocks after they've already moved. You're waiting for confirmation before they really take off. There's a classic example he used with Goodyear. For months, the stock was stuck moving sideways. Nothing exciting, no headlines, no hype. Most people would scroll right past it. But then it broke above resistance. Volume picked up, and price moved above the 30-week average. That was the signal. And from there, the stock went on to double within about 9 months. Now, at this point, you might be thinking, okay, that makes sense historically, but does this still work today? Because markets change, right? Strategies stop working. That's a fair concern. So let's look at a more recent example. Tesla in late 2019, before the huge run that everyone talks about now. Back then, it was just moving sideways for a while. No major excitement. Then suddenly, you start to see the same pattern. It breaks above resistance. Volume increases sharply. Price moves above the 30-week moving average. And there's one more layer here that Weinstein added later. Relative strength. This measures how strong a stock is compared to the overall market. Ideally, you want to see it move from weak or neutral into positive territory, right as the breakout happens. Weinstein called this the triple confirmation. Price, volume, and relative strength, all aligning at the same time. And when that happens, the probability of a strong move increases significantly. With Tesla, that's exactly what happened. And after that breakout, the stock went on a massive run in a relatively short period of time. Now here's where things get a little uncomfortable. Because even if you understand when to buy, most people still struggle with when to sell. And this is where a lot of gains quietly disappear. Weinstein was very direct about this. When a stock starts moving into stage 3, you need to pay attention. When it breaks down into stage 4, you exit. No debate, no waiting to see what happens. No holding on because you like the company. There's an example he used with Avon. The stock had already gone through a strong advance. Everything looked fine on the surface. But then it started to stall. It entered that topping phase. And eventually, it broke down below key levels. The 30-week moving average turned downward. That was the signal. And what followed was a significant decline. The key idea here is simple, but not always easy to accept. The market doesn't care what you paid for a stock. It doesn't care about your expectations. It only reflects supply and demand. And if the structure changes, you have to respond to that. This is why Weinstein emphasized discipline so much, because the strategy itself isn't complicated. What's difficult is following it consistently, waiting during boring periods, acting when the setup appears, and exiting when the signals say it's time, even if you feel like holding on. So if you wanted to simplify this into something you can actually use, you'd start by asking a few basic questions when looking at any stock. Is it in a basing phase or early uptrend? Is it breaking above resistance? Is volume supporting the move? Is it above the 30-week moving average? And is relative strength improving? When those conditions come together, you're looking at a strong setup. On the other hand, if a stock is breaking down, losing support, and entering a clear downtrend, that's your signal to step back. Or, if you're more advanced, potentially look at it from the short side. At the end of the day, this isn't about predicting every move perfectly. It's about understanding the environment you're operating in. Because once you start seeing stocks through this lens, they stop looking random. You begin to recognize patterns. You start to see when something is building and when something is breaking. And that's where the real advantage comes from. Not from reacting late, but from understanding what stage you're in before the crowd catches on. So next time you look at a chart, instead of asking if it's a good stock, ask yourself one simple question. What stage is this in? Because that one shift in thinking can completely change how you approach the market. If this helped you, hit the like button, subscribe to the channel, and drop a question or comment about the one trading mistake you're working on fixing. Are you ready to take your trading to the next level? Click the link in the description now and get started today. Also, check out the next video on your screen. It'll show you exactly how to time your entries once you've locked in the higher time frame direction. See you next time.